Hey, good morning, everybody. Welcome to another day of Market Report brought to you by Mike Bjork. Today's Hump Day. Wednesday, September 17th. Bit of economic news releases scheduled for today. We'll start off with the Consumer Price Index for the month of August. So back in July, we had a zero point 0.1 increase for inflation numbers. So these are inflation numbers, and these are on consumer level. So these are one of the two important ones, along with the PCE. So for the forecast for August, it was supposed to dip down to about zero, and it actually came at -2, which is based as a result to the lower gas prices and lower food prices as a result. The core, when we strip out the food and energy prices, we got the core, and we had a zero point 0.1 again also back in July. It was supposed to go up in the month of August, and actually dipped down to zero. So very, very, very tame numbers we're seeing here on inflationary numbers on the consumer level. And then we got the home builders index. What this means is that the confidence level for home builders, this is kind of a gauge as to if they are confident where the economy is moving, if they will continue building. So we had a 55 back in August, and the forecast was supposed to have a slight increase for September, and it actually jumped out to 59. So good reporting there, nice little jump there that they're feeling a little bit more confident where things are moving and confident that they could build more homes. And last but not least, we'll have the FOMC meeting today, wrapping up with their announcement at about 11 a.m. Pacific Standard Time. They'll give their announcement at that time, and they'll have the press conference at 11:30 Pacific Standard Time. So expect a lot of volatility in the meantime for this, and it could get a little crazy as they try to cipher through what was said as a result. And tomorrow we may have get a little bit more of a correction. So let's say if they overreact today, tomorrow they'll probably correct where it should be in line after they've had 24 hours to digest what the information that was being provided this morning. So as a result, the stock market started off a bit higher in anticipation, and then since then it's pulled back a bit. So it's just barely treading water as being upward bound. Now, a lot of it had to do with some numbers that came out of China, that their central bank is injecting about 85 billion dollars into the banks to try to counter-react the slowing economy that they're injecting. So the investors obviously like that because China, for a while now, has been declining in their economy, and we're wondering if they're going to do a kickstart to try to improve it, as many of the Western countries rely on them for trade from the U.S. to Europe. So let's take a look how this is affecting the bond market, see what interest rates are doing today. We have a slight improvement, not much to make a difference in the interest rates. We were at 101.19, and we're currently at about 101.22. So only about 3 basis points right there. So not enough really to make a change. But again, this could all dramatically change after the Fed gives their announcement later today. So be very, very cautious on this. So this could go either way. The thing that they're really looking for in their statement on the Fed is the considerable time. So as we've talked about for the past week, the investors are concerned about that maybe the Fed may feel that the economy is moving at a greater pace right now, and that they may move up the date for the first rate hike. So that's the concern. Initially, everybody believed it was going to be like the second half of 2015 or about middle time frame. Now they're thinking it maybe could get bumped up to the spring. So that's where the concern is. So the key phrase is if they remove the language "considerable time" in the Fed speak today, then you could see maybe a rally in the bond market, and equities kind of taking a little bit of a drop, stock market taking a bit of a drop as a result. Now, if they keep that in there, the stock market could have a nice little rally, and that could come as a result at the expense of a bond market, which would increase rates today. So be very cautious and look for that considerable time, those two words in their statement today. If it's in there, it's bad for bonds. If it's taken out, that could be good for bonds today. All right. Have a wonderful day. We'll look forward to see you guys tomorrow, and thanks for watching.